guys, today we're going to talk all about accounting basics. We're going to discuss everything that you need to know before you start up on your study on basic accounting. So, let's start. Today, we're going to discuss what you need to know for your basic accounting. We will be tackling about the core principles of accounting. First off, what is accounting? Accounting is the process of recording financial transactions pertaining to a business. The accounting process includes storing, sorting, retrieving, summarizing, and presenting the results in various reports and analysis. Now, the financial statements used in accounting are a concise summary of financial transactions over an accounting period, summarizing a company's operations, financial position, and cash flow. Now, if we talk about this definition, it might be too technical for you, especially if you're just starting your basic accounting subject. Now, let's define it in a more basic sense. So, basically, accounting is to account. When we say to account, it's to make a report or description of an event or experience. In the business sense, describe the financial events of the company. Think of it as a bigger and more complex process of how you account your personal finances. For example, your parents give you an allowance for the month, or maybe you earn it from your side business, or maybe you earn it on the side. Now, you list all your expenses for the month, such as cell phone load, buying shoes, K-pop merchandises, diamonds for computer games, or the food that you eat every day. Now, when you list it, you can summarize how much was the total cash you expended and how much you have left. Now, for the month, you will know how much did I spend on food? How much money did I use to buy shoes or clothes, or to pay for my diamonds or for my skin in my computer games? Now, once you summarize it, and let's say you have to budget for the next month, then you will have a clearer data on which to base how much or how you should change your spending for the next month. Like maybe you have to save more, then maybe you should allot more on your savings, and then maybe you should lessen your expenses for the food or for the K-pop merchandises or whatsoever. Now, it's very important that you summarize it, and it's very important to have this report for you to make the proper and better decisions for the next period. In accounting, we do this, but in a bigger scale, since we are accounting for the financial transactions of the company. Now, once all the financial transactions of the company are summarized, then now we could present a report, which, as we call, is the financial statement. So basically, the financial statements are the reports that we use for the transactions that we have summarized. Now, it is a concise summary of financial transactions over an accounting period. When we say accounting period, it could be a week, it could be a month, it could be the 6 months ended or the year ended. We're just talking about the period that we're accounting all our transactions for. So when we say only for the month of March, then you'll just summarize and make a report or a financial statement for the month of March. It depends which accounting period you're working on. Now, summarizing a company's operations, financial position, and cash flow. Now, we will discuss this a bit later. Now, as with everything in our life, actually, we have to understand why are we doing what we are doing. And also, in accounting, we have to understand what is the relevance of accounting for a business. Now, accounting plays a vital role in running a business. If you're going to be an accountant in the future, or maybe you're just an entrepreneur trying to understand the basics of accounting, now we have to understand that accounting plays a vital role in running a business. First of all, it keeps a record of all your business transactions. Even if we're just making financial statements for 1 month, if we do accounting, all the transactions of our business is recorded and stored. Now, number 2, it facilitates decision making for management. As we said earlier, like in your personal finances, if you have to budget for the next month, having the previous month's summary report will help you in understanding how you spent your money, how you spent your resources, and it will help you in planning how to better spend it on the next period. Now, for number 3, it communicates result. The result of the financial transaction of the company. Now, for example, you're an entrepreneur. It's a good data to use to answer what happened in your business for the period you're looking into it. Like, for example, what happened to my business last year? Now, when we do accounting and we have financial statements, it will be much clearer, and we can see the data of how our business did for the last month. Now, fourth requirement is meeting the legal requirements. Now, proper accounting helps organizations to ensure accurate reporting of your financial assets and liabilities. For assets and liabilities, we'll discuss that a bit later. Now, especially like for the government, if you're paying taxes now, accounting ensures that you're properly reporting your revenues, your expenses, your assets, and your liabilities, so that the government or these legal bodies will know that you are properly reporting your books and you're properly paying the taxes that is due from you. So it's really very important, especially if you want your business to run smoothly. You have to keep a record of what's going on in your business. And you as an accountant, you will help business owners to do that. If you're a business owner, or if you're an accountant in a company, this plays a vital role for your company. Now, who will use these financial statements? Remember, our financial statements communicates result to who? As we've said, for the owners, for the business owners, for the managers and employees, but also there are who we call the external users. Now, who are the external users? This could be the suppliers, this could be the banks, the customers, the present investors or future investors, and as we've said, the tax authorities. Since we are giving this report to these people, it's because they have stake in our company. For example, I'm a supplier and you're giving me your financial statements. I am your supplier. Now, I need to know if your business is doing good, because I need to know if I should supply more to you, if you can pay your dues to me, and if we could continue doing business together. Now, it could be a bank, like for example, I am the bank and you have a loan from me. Now, I need to know how your business is doing to know if you're able to pay for your loans. Now, these are the users of the financial statements, as we call it. Now, it's very important to communicate to these stakeholders using our financial statements, because in our financial statements, they will be able to see how our business is doing. Now, how can we communicate with these people, with these users, how our company is doing? The income statement, the balance sheet, and the cash flow statement. Now, when we say income statement, basically from the word itself, income, this provides you with information about the profit or loss in your company. It basically is a statement summarizing all that happened, all the transactions in your profit and loss. So in the bottom line of this statement, we will know if we had an income or we have a loss. So basically, it summarizes the operations or how your operations affected your profit. This statement will give you the information so that you'll know if you really are profitable or if you took a loss on the previous accounting period. Now, for the balance sheet, basically, balance sheet. This gives you a clear picture of the financial position of your business on a particular date. Let's say your land. It gives you the balance of the land. It gives you the balance of all your assets, of everything that you own, so that you'll know how is your financial standing. Do you have many assets? Do you have liquid assets? Do you have tons of liabilities? So basically, this gives you the position, your company position, the financial position of your company on a particular date. For the cash flow statement, it is a bridge between the income statement and balance sheet and reports the cash generated or spent during a specific period of time. Basically, we will see the movements of cash itself. Basically, that's what cash flow statement is for, so that we'll know how the company manage its cash. Now, remember, these are three key financial statements, but there are also other statements such as statement of changes in equity or a statement of other comprehensive income. Now, these are just the summary or general that we use the financial statements for. Now, how do we create the financial statements? How do we have the financial statements? Like, for example, in your personal finances, we make a list of all the transactions and then we summarize it. Now, for accounting, it's a bit much larger scale and processes. So, we're going to discuss the accounting cycle. Now, for accounting, we have to remember that the essence of it is just basically to identify the transaction, if a transaction occurred, and then process it up to the time so we can report it for the financial statements. Basically, that is the beginning and the end of our process, to identify the transactions and process it and summarize it up to the point that we can make a financial statement, a financial report, which will be used by the internal and external users, which will be used by the owners to facilitate decision making, and even for the stakeholders of your company. Now, how do we report it? How do we record it? How do we summarize it? How do we give out the report? Now, what we're going to discuss next are the accounting steps that we must do. Whatever company you might be in, it might be a small company, maybe a startup company, maybe a partnership or a corporation, the accounting steps will be the same. Now, it is very important for us to understand the core principles of this, how we do this, and now if we really take a hold of how to process the data, how we process, how we account for the data, then it actually will be easier for us to go along with other subjects in the company. It's very important to know these accounting steps. So we will learn how to analyze and identify transaction, about journal entry recording, posting to general ledger, about the unadjusted and adjusted trial balance, along with the adjusting journal entries, and we will see what is the financial statements and what are closing entries. Now, let's discuss all the steps that a financial transaction goes through from the inception to the ending, the financial report. The step one is to analyze and identify transaction. In analyzing and identifying a transaction, we have to understand the concept of double entry bookkeeping. Now, when we say double entry bookkeeping, always remember that when you make an entry, there is always a double entry, a debit and a credit. Remember a coin whenever you're recording a financial transaction. Think of it as the head is the debit and the tails is the credit. Now, whenever you enter a debit, there should always be a corresponding credit. And for every credit that you enter, there is a corresponding debit. Now, for our double entry bookkeeping, look at this graph. Now, we can see that the debit should be equal with the credit as always. And we can also see this in the accounting equation of assets is equals to liabilities plus capital. Now, the debit side or the asset side is actually what we own, what the company owns. Let's look at it from the standpoint of the company itself. Now, what the company owns is the assets or the financial assets as we call it. And what the company owes is the credit. These are the liabilities and the capital. Now, the company may owe some of its assets, meaning you took a liability to pay for an asset, probably then you have a liability and you owe that amount to your creditor. Now, there is also the capital. Now, if you look at it as a company, the company owes its assets, of course, from its owner, which is the capital. The capital is the contribution of the owners to the company. Now, the company owe the owners, of course. That's why the credit side is what we usually call as what you owe. So remember the accounting equation that assets is equal to liabilities plus capital. And remember the double entry bookkeeping that for every debit, there is always a credit. Now, when we record for the journal, remember that when we increase the asset, it is a debit. If we increase the liabilities or the capital, it is the credit. Because that is their normal account. Now, we have already counted the real accounts. That is assets, liabilities, and capital. Now, nominal accounts are what we call the revenues, expenses, gains, and losses. A nominal account is an account in which accounting transactions are stored for one fiscal year. We only use this for an accounting period. If, for example, for one fiscal year. Now, at the end of the fiscal year, the balances in these accounts are transferred into permanent accounts or what we call the real accounts or what we call the assets, liabilities, and capital. Now, for example, the revenue. For 1 year, for one fiscal year, we record everything in our revenue account. But at the end of your accounting period, we close it and transfer it to the balance sheet accounts or the permanent accounts or the real accounts, the assets, liabilities, and capital. So in the next fiscal year, it will go back to zero again. And that's when you record. And at the end of that year, again, you summarize it, you close it. So the purpose of this is to get the revenue that you earned for the accounting period you're working on. So if you're working on one fiscal year, we have to return it to zero so that we'll know what's the total revenue that we got for only this 1 year. That's the purpose of the nominal accounts. We close it so that we can go back to zero again on the next accounting cycle and know how much is the revenue for that accounting cycle. For the double entry bookkeeping, let's take an example. For example, on April 5, you paid rent expense for the following 12 months in cash. Now, you will use this rent expense, or this is the rent you pay for April to March of the next year. So you got a prepaid rent of 12,000. You increased your asset of prepaid rent of 12,000, and you decrease your asset of cash because you have, of course, you owe the prepaid rent. You have to pay it. You have to credit cash of 12,000. Now, on September 2, you bought a land through a liability, meaning you took a loan, for example, from a creditor and used that money to pay for the land. So you increase your asset of land to 220,000, and you increase your liability. So that's a credit to payable of 220,000, meaning you have a liability, something that you owe to the creditors that you have to pay on your agreed terms. Now, these are the entries that we do in identifying a transaction. Remember, for every debit, there is always a credit. Now, in our first example, we have debited prepaid rent and credited cash. And in our second example, we have debited land and credited payable. So for the step 2, after identifying the transactions, we have to record it. And where do we record the transactions? Of course, in your journal entry. So let's take a look at the concept of a journal entry. So journal entry recording. This is recording of the transaction on the respective accounts. What is debited? What is credited? When was the transaction? And what transaction happened? Now here, like in our example earlier, we have to debit what should be debited and we have to credit what should be credited. In our example of buying land, we have to record land. Of course, on the land account, not on the cash account, not on the building account, and you have to record the liability, not on the capital account. So you have to identify which accounts you have to record the transactions in. And remember, if we have to increase the asset, we're going to debit it because it's the normal account of the assets. So what if we have to decrease it? Then we should credit it. Just the opposite of it. Now, the next step is general ledger. This is where we summarize per account. Remember that in the journal entry or in the journal recording, we record all the transaction according to date, according to when it happened, but it's still just a big record. And after that, that's when we have to summarize it using the general ledger. So in general ledger, we just have to summarize per account. Remember, when we are posting to the general ledger, we are just summarizing everything that happened for the prepaid rent, for the cash, for the land, for the payable. So we have this, what we call T account. Basically, it's just because it's letter T, that's why we call it the T account. So, for example, in your personal finances, think of it just of summarizing all that you spent on food, all that you spent on fashion, on your clothes, on your shoes, all you spent on your computer games, all you spent on your cell phone load. So basically, general ledger is just summarizing. We have to summarize per account. And since we have many different transactions and many different accounts that we use in a journal entry, we just have to transfer it from the journal entry recordings to the general ledger. So we just have to summarize it per account. We summarize everything that happened in the prepaid rent, or in the cash, in the land, and many other different T accounts depending on the transactions of your company. There are expenses, revenue, capital, everything. Every account that you summarize it per account. And this is how it will look like. Remember, once a transaction is recorded as a journal entry, it should post to an accounting account in the general ledger. So the general ledger provides a breakdown of all accounting activities by account, and this allows the user to monitor the status per account. Now, once we have summarized and posted to the general ledger, remember we have real accounts and nominal accounts, and the general ledger provides a breakdown of all accounting activities by account. Now, once we have done that, now we proceed to our trial balance or unadjusted trial balance. This is the summarization. Like we have now group our transactions per account, right? So as you can see in a T account, it has all the debits and the credits of an account. Now, when we go to the unadjusted trial balance, basically we just summarize everything line per line. As I show you, this is how a trial balance looks like. So basically, the adjusted trial balance just shows the balance after every transaction has been recorded. It shows the balance line per line. Now, as you can see, we have here the debit balances, meaning these are our assets because their normal balance is a debit balance. Now, we have cash accounts receivable, office supplies, prepaid rent, land, vehicle. So these are all our assets recorded as a debit balance. And of course, for our liability, like the payable, the deferred revenue, and our capital, these are recorded as a credit. These are credit balances because that's their normal account. Also have the nominal accounts. Revenues, which has a normal credit balance, is recorded as a credit. And the expenses, which has a normal balance of debit, is recorded here as a debit balance as well, such as salaries expense, rent expense, supplies expense, advertising, and insurance. Now, as you can see, for every debit, there is always a credit. That is our double entry bookkeeping principle. And as you can see here, the debit is equals to the credit. So that's how you check if you recorded all the transactions properly. The debit should be equal with the credit. Once we have summarized it line per line on our unadjusted trial balance, what's next? We do the adjusting journal entries. What is this? Let us define what are adjusting journal entries. So adjusting entries ensure that the revenue recognition and matching principles are followed. All necessary adjustments are recorded to be in compliance with the IFRS or the GAAP. Remember, when we say financial accounting, it actually pertains to accurately presenting the financial information. Now, how can you accurately present it? That's by following the IFRS or the GAAP, the financial reporting standards, or the generally accepted accounting principles. Now, we have to do and use accounting principles so that we will properly report our financial information, such as our revenues, our expenses. So we have to make all the necessary adjustments to be in compliance with the financial reporting standard. Or just to say that the financial information we have reported is accurate and fairly presented. Now, for us to understand more about adjusting journal entries, let's have an example. In our earlier transaction, we paid rent for 12,000. Now, this 12,000 is for 1 year, starting in April. Then it will be good up to March. It will be good for the rent expense up to March. But our reporting period is until December only. Now, in accounting, we have to ensure that our financial information is presented accurately. Now, we can't report the whole 12,000 as rent expense because the 3 months is not yet incurred. We have only incurred 9 months of rent. So the proper rent expense is $9,000. That's 12,000 divided by 12 months, incurring 9 months of April to December. So the total is $9,000. Now, see this. We only record, since our reporting period is December, we only record the rent expense from April to December. So the remaining three months will still be the prepaid rent. So meaning we have a prepayment for rent for the 3 months. But as of December, we have incurred a rent expense of 9,000. Now, remember, adjusting entries are very important because it makes you make the necessary adjustments so that your financial information will be accurate and correct based on the standards that you're using. And in this case, we have to report that the true or the correct rent expense is only for the 9 months. Now, as you can see here in our trial balance, the first column is the unadjusted trial balance. If we go to the rent, first we go to the prepaid rent. Remember, we recorded it as a prepayment in April. So as an adjustment in December, we record a credit, or we subtract it with 9,000, which is the rent expense for the period. So from your prepaid rent, we record it as your rent expense for the period. So here we can see that the unadjusted trial balance has a 0 balance for rent expense because we haven't yet recorded the rent expense for the year. So we made an adjustment and recorded a $9,000 rent expense. So here is our trial balance with an adjusted trial balance and the adjustment. So if there are any more adjustments that you make, you have to summarize it and put it as how it will affect on your adjustments column. Now, once we are done with the adjustments, so that we have followed and correctly reported our balances according to the IFRS or the GAAP, we will now update our trial balance. Now, this is where we go to the reporting. After we summarize, after we correct the financial information through the adjustment, we now report it. So here, we will see our adjusted trial balance. We have seen the first column of unadjusted in the previous slide and the adjustments on the previous discussion. Now, this rightmost column is our adjusted balance. This is our adjusted trial balance. Now, basically, this is just the balance after every adjustments have been incorporated in your books. As you can see, the debit and credit should always be equal. But since in this case, we only use one column for both debit and credit balances, if we sum up everything, then it has to be 0, meaning the debit is equals to the credit. Now, after we have done our adjustments and have our adjusted trial balance, after the company makes all adjusting entries, the balance is updated. And we can now generate the financial statements. This is our next step. Our step 7 is to report via the financial statements. The balance sheet, the income statement, the statement of changes in equity, the statement of comprehensive income, of other comprehensive income, and the notes to your financial statements. Balances in the financial statements are generated from your adjusted trial balance. Now, the financial statements are made at the very last of your accounting period. So when you finalize your balances, you can now make your financial statements. So we use the adjusted balances for our financial statements preparation. So it's quite easy when you now have your adjusted trial balance, because now you just have to make it into a report. You have to summarize it in a way that will be very clear and understandable for your financial statement users. So here we have an example of the income statement and the balance sheet. Remember, these accounts are from the adjusted trial balance. So you just copy and paste all these amounts, and then we summarize it. First is the income statement. Now, this is where we summarize our nominal accounts. Remember, the revenues, expenses, gains, and losses. Now, here we have a revenue of 350,000. So remember, the expenses that we have, or the debit balances, are the salaries expense of 50,000, rent expense of the 9,000. This is adjusted balance. The supplies expense, the advertising, and insurance, all for a total of 69,000. Now, our net income for the period is 281,000. Now, for our balance sheet, this is where we summarize all the real accounts, the assets, the liabilities, and the capital. Now, for our assets, we just have to enumerate our cash of 630,000, our accounts receivable, office supplies, prepaid rent, land, and vehicles, all for a total of 1,061,000. Now, for the liabilities, we summarize the payable and deferred revenue of 280,000. And for the capital, we have the capital beginning of 500,000 plus the net income for a year of 281,000 for the total of 781,000. Now, remember, the accounting equation assets is equals to liabilities plus capital. So when we add the total liabilities and the total capital, it will be 1,061,000, which is equals to your total assets. Remember, this should be equal. The debit is equal to the credit. For our last part, now, after the financial statements, we have to make the closing entries. This is where we close the books. Remember our discussion about the nominal accounts that you have to close on the end of the accounting period? So, this is it, closing the books. Now, at the end of an accounting period, closing entries are made to transfer data in the temporary or nominal accounts to the permanent or real balance sheet or income statement accounts. Now, transferring the balances of the temporary accounts to the owner's equity or retained earnings account is used because this type of accounts only affect one accounting period. We have discussed the nominal account, which only is used for one accounting period. Now, when we have to close it, we transfer it to our retained or the earnings that we have retained, or to the capital or owner's equity account, to the capital. Now, the closing statement provides a report for analysis of performance over the period. Now, after closing, the accounting cycle starts over again from the beginning with a new reporting period. At closing, it's usually a good time to file the paperwork, just fix every document, plan for the next reporting period, and review the calendar for future events and tasks. Now, we have discussed this nominal accounts, and at the end of the accounting period, when we close this to the real accounts, then we have a fresh start, and we have zero revenues, expenses, which will be accumulated again as we have transactions for the next accounting cycle. So once we're done with these processes, we have completed our accounting cycle. So remember, from the beginning, we analyze and identify the transaction, we record in the journal entry, we post it to the general ledger where we summarize per account, we make the unadjusted trial balance where we summarize the balances line by line, and then do the adjusting journal entries, and then update the balances and have the adjusted trial balance. We can now then do the financial statements and finally do our closing entries. When we have done all of this, we've finally finished our accounting cycle and we're ready again for the next accounting cycle. So understanding this accounting cycle is very important because once you really do accounting as a work or as a job, it's what you will do as an accountant. So I hope you do understood our topic for today and that you really understand the relevance of accounting and of the accounting cycle so that when you study more subjects, this will be easy peasy for you. So that's all for today, and I hope you did learn from this video.